Hello, welcome back to Laptop Trader Channel on YouTube. My name's Philip, and I will be hosting this month's presentation. I am here to share my trading experiences and give back to the stock trading community one video at a time. This channel is mainly for new traders or new investors, but all are welcome. Okay, my goal is to educate you and to get you up to speed and to keep you from losing money in trading and help you understand the markets. So we publish monthly video which covers the current markets, market analysis, how to enter and manage trades, and how to create confidence by putting the odds in your favor. If you wish to be updated when new videos are published, hit the subscribe button now. My email contact if you need help is laptoptraderphil@gmail.com. This video is for information only and should not be considered investing advice. Caution, trade at your own risk. Most stock day traders lose money. Okay, be careful. Please protect yourself at all times. Any stock suggestions are up to you to decide if that is appropriate for you. So good luck and God bless. Let's get to this month's topics. As I always say, start now by educating yourself on how markets work and finding out what is right for you. Invest in yourself, then invest in the markets. Our agenda for this month, we will be looking at just the overall general topic of reading the market. Okay, how to use multiple time frames in technical analysis, how to see a trend on a chart, what are stock valuations and why stocks sell off or are bought at certain points on the chart, and how a valuation affects buying and selling, valuing a company using market cap and income and other ratios such as PE ratios, price divided by sales ratios, and others. We have an interesting market so far in 2026, with larger stocks selling off and small caps going up in general. So we're seeing some rotation or money flowing from one area to another. We'll do some general market chart analysis since our last video in January. And we'll also look at seeing the different stages in rotation on a chart. And also, for you guys, I don't rely on the news, but I do my own homework. So, I encourage you to not rely on the news, but do your own homework as to what is a good investment or trade idea for you. Okay, so if you do a little homework, I think you can find some good trading or investing opportunities. All right, reading the market and stocks using multiple time frames. Okay. In general, you will see moves in larger sector funds or industry ETF funds before you will see these moves in the overall diversified market ETF funds like the SPY and the QQQ or NASDAQ funds. Okay. And that's because those funds are so large. I'm talking about the SPY and the Qs that they can oftentimes hide what's going on in the market until all of a sudden everything begins selling off or everybody begins buying again. So we can kind of break this down to try to catch some moves earlier. And you also see moves first in individual company stocks first before the industry or the sector ETF funds. And I'll show that to you. Now, by looking at the markets first and then the stocks next, you can get a feel for the market context or the story at that time. So this would be considered kind of a top-down approach. Now, oftentimes after I get that general overall approach, I kind of prefer to look at stocks from a list of stocks first, then confirm my thoughts by looking at the market context second, or referring back to the context just to verify. I feel it helps me get a clear picture of what is going on inside of the market. So this is a little more of a bottom-up approach. Either way is right or okay. You just need a clear direction for your forecast that day or that week or whatever time frame you plan on trading. Okay? And I think this will also help some of our investors out there that, just kind of buy and hold and maybe really don't understand how the market works. But in general, you will see a larger context and a higher time frame, and you will see moves sooner in a lower time frame. And I'll give you some examples of that. Also, this will alert you to volatility and changes before you see them in the overall market. Like if we hit a bottom or a top, or we have been in a range for a while now, a certain industry, let's say like energy, is breaking up or down. So we can see volatility on the price chart. And the VIX index is just an indicator, in my opinion, or a confirmation of what we are seeing, as the VIX is a reaction and moves quickly with leverage. Internet AI search says the VIX is forward-looking and not historical. But I somewhat disagree with that, as I find it very reactionary to the day with any news or uncertainty or fear in the markets. Just look back at 2008 or March of 2020 during the pandemic for reference on volatility levels. I personally do not use the VIX in my trading unless maybe I'm considering selling an option, as higher volatility affects options pricing. So that's a quick overview on that. If you've ever heard of the VIX, or even if you haven't heard of the VIX, that's a little bit of how that works. So a few more definitions so we're on the same page before we get to the charts. Market capitalization, or market cap, is simply the size of the company based on the price of the stock times the number of outstanding stock shares. So for example, a $50 stock times 1 million shares would equal a $50 million market cap, which is fairly small by Wall Street standards. Many companies are valued in the billions, or some now in the trillions of dollars for a single company. We also have what's called a PE ratio, which is the price to earnings ratio. It's the price of the stock divided by the earnings or earnings per share. And it's generally a fairly low number. 10 would be fairly considered low. And many investors find a fair value around maybe 20 or 25. But some companies have very high ratios, signaling potentially high risk or even an overvaluation. Now, that's not always the case. Something like Tesla has been overvalued for years now. It just seems to disregard earnings per share versus price. So that's not always a guaranteed thing. But we can also look at something like market cap of a stock, or the size of the company divided by its net income or profits, or its net earnings. And it's a number we can use to check if the PE ratio is kind of fair, and to check for maybe a growth opportunity. Okay, a low number may signal a growth opportunity. A similar ratio that also helps in valuing companies is price divided by sales. This may help us get a handle on how the company is valued or viewed by larger investors. Now, just because a company has a low PE or a low price divided by sales, or even a low price divided by earnings divided by growth, does not necessarily make it a good buy. We must take into account a larger picture, including context of the market, context of the sector or industry that stock is in also. Because many times, just because the company has low ratios or good earnings, it still may be in a downtrend, or it may be in an industry that's been kind of beaten up, okay? Also remember that valuations can get extended, and this will be reflected in the price, and you can see that on a chart. Buyers and sellers are still creating supply and demand based on many factors, and these ratios do not always tell the full story, but it can give us a quick just a quick gauge, I would say. CMG or Chipotle Mexican Grill, as an example, may not have had net income, but still may be on a growth trajectory with new stores and many new locations. So that would be part of its story. Also think of something as a new technology like Tesla, right? Newer electric cars and a growing new market for those products. So use common sense like something new and popular, like streaming TV services such as Netflix, symbol NFLX. Or, for example, Peter Lynch told the story of how Taco Bell was a new company with a growth plan to expand into most cities in his book, One Up on Wall Street, when he bought the stock for his fund company. So I thought that was a pretty good book on valuations and looking for new potential opportunities. Anyway, a price chart is just a picture of what buyers and sellers are doing at any point in time, signaling supply and demand. Valuations can be varied by individuals and investors for different reasons. But the thing to remember is valuations become high is that are investors willing to keep buying for higher prices and expecting a smaller return on their investment dollars. And the same is true as the stock or market is falling. Right? At what point does this company become a great bargain based on its valuation compared to its earning potential and also with its dividend yield? If it pays a dividend back to investors. So those are some things to consider when kind of looking at a value of a company versus, where the price is at on a chart over time. So I hope that helps out. We can look at some charts here and just kind of get into not so much valuations yet, but this is a company, Mercury Systems, symbol MRCY. This is a stock that I personally bought in April 2025, but then I sold it early right here within a month. Now, and today it's up here. It's up over 100% in about 9 months. So, sometimes you can buy something that looks good, but then I don't remember if I got stopped out this month or if I just felt, it wasn't moving fast enough. But, I had a profit that I took on this. I didn't lose. I took a profit, but I left so much on the table because of a few things. One, I was probably trading on the daily chart. Sometimes the daily charts can get kind of crazy. I should have looked at this monthly chart and realized, this has the potential for a greater move up. So that's one reason to use longer term charts, such as a monthly or a weekly chart. So that's kind of all I wanted to share with you on that. This is a chart of Nutrien Limited, symbol NTR. I just wanted to give you an example of a stock with price correcting over time and then getting to a point where buyers wanted to buy again, signaling this stage 2, an early stage 2 uptrend. Okay, so if you haven't watched my other videos on stages, or if you've never read the book How to Profit in Bull or Bear Markets by Stan Weinstein, I would highly recommend that book. I think it's very helpful. But long story short, here you have what's called a stage 2 uptrend, which is where you want to be when you hold a stock. And then there's a stage 3 plateau area where a stock is prone to sell off from. And then you've got what's called a stage 4 downtrend, back to what's called a stage 1. Many times stocks will consolidate in a stage 1. Many times they will go out of business if they're not established. But many times out of stage 1, we can look for a new opportunity for it to return to a stage 2. And that's what it looks like I'm seeing here on this company. So I hope that helps. Just kind of define some of those stages and kind of what I'm looking for as far as a new opportunity. Now here's that same company only in a daily chart over a 9-month time frame. And you can see on this chart you have this resistance area here, and then it finally breaks out over that resistance area to new highs. You can see a support area down here in stage 1. You can see some volume spikes where this volume spike preceded this higher low versus this area. And then you've got another volume spike here with a breakout. And when this broke out, there's no resistance left on this chart. And that's why prices moved up, because supply all of a sudden was gone and demand took over, or buyers took over and pushed prices higher. Okay. Now let's get to this year and the beginning of 2026. So this year is becoming very interesting versus the last several years, as the two major index ETF funds are seeing some selling pressure, and the other side of the market, and small caps and industrials are leading the market higher with some buying pressure. So that has not been the case in recent history, as large cap growth or tech companies have been leading, such as big names like Nvidia, Microsoft, and Tesla, etc. Now we are seeing more industrial and energy and consumer staples kind of take the lead in this market. Why is this happening? Well, in a few words, valuations and rotation into other areas for growth. The market kind of self-corrects over time for excesses in price versus the value of a company, or price versus valuations. Okay, the companies in any market or sector or industry need time for the revenues and the sales and the net income or profits of those companies to kind of catch up to the price or valuation of those companies. Remember, the market is looking forward and pricing in future profits. This is why you will see a base or a consolidation form on a chart after a strong uptrending stock or a general market. The current demand does not match the future outlook, and so people now wait and see if these companies can continue to perform, which leads to a rotation of money into other areas of the market that have stagnated and or sold off over time. Okay. Now, these areas or companies may look like a good bargain at this time at today's price, which is what I think we're seeing in this chart of Nutrien, right? It's sold off and now it's looking like a better bargain, so to speak. So now this may look like a base or a bottoming pattern, or a stock that was in a downward trend now reverses back up. We can see this on some example charts. Again, this would be considered like a bottoming pattern or a stage 1 base, and that looks like it's going to return to this uptrend this year. So let's take a look at some more examples. So these next 3 slides are only for examples to demonstrate the idea of a trend up, down, or sideways. And how would you invest in these, or would you invest in these? So here's a chart, which is a 2-year weekly chart of Merck and Company, symbol MRK. We can see on the chart pretty clear, stage 3, then a stage 4 downtrend, and then we've got the sideways trend here. And then we've got kind of this igniting green candle sideways for about 5 or 6 weeks, and then another nice expansion upward in price to the upside. So that would be an example of a chart that's now in an uptrend. So this chart suggests demand and higher prices as buying pressure is pushing prices higher at this time. A likely target would be maybe 135 to 140 near this old high point to the left. You can see all this congestion to the left, and at that time this was a high point on the chart. So a lot of times stocks will get to these high points or these resistance or supply areas and kind of stop there, at least for some period of time. So that would be a likely target point on this chart. That's all I'm trying to show you there. This is a chart, which is again a 2-year weekly chart of Abbott Laboratories, symbol ABT. You can just see how the stock kind of, if you read it from left to right, was down, then sideways, then up, and then went sideways for quite a long time, and then finally rolled over or had kind of this serious, significant drop in price more recently. And there are several reasons on this chart that would indicate that was going to happen. One is it hasn't made a new high in a long time. Two is we've got these wide range red candles that you can see here. We've got these points called pivots, which are not making new highs, they're actually making lower highs. Then we get this lower low, and then we get another wide range red candle here, here, and here, and then anywhere below this area, would be a break of support, and that's what happened here. Support was broken, and sellers and supply kind of took over that market in a fairly quick way. And here I just drew that out, right? Showing resistance, support, and the stock kind of rolling over, and just simply not as much demand. It can't make new highs in price. And again, below that support level suggests lower pricing, and that's exactly where we went with Abbott Laboratories. Okay, makes sense? This is a longer term chart of the same company, Abbott Labs, on a monthly 5-year chart. And pretty interesting is that if we look to the left from this congestion or this supply area, we see that in the past this was also a congestion or a resistance or a supply area. And that's interesting that that got up to that point and just could not get over that point. So that's also an interesting thing about technical analysis, is that many times looking to the left can give you some guidance as to where a stock may get to. Now, if it had broken over that point, over that resistance, you've got blue skies up here where there's no resistance. So if this would have broken out to the upside, I think that would have been a pretty clear signal to buy and hold on for future profits. And then the third chart here, I'll show you Walt Disney Company, symbol DIS. To me, this is more of a chart that is long-term, 2-year sideways trend where price to the left closed around here, and today it's just slightly lower here, indicating just a big giant sideways trend. So if this stock didn't pay dividends, then over this 2-year period you would have actually lost some money just based on the fact that price never really went anywhere. So it's kind of not a very good investment at that point. I'm not saying Disney's not a good investment. I'm just saying in this time period, it hasn't been a great investment. Now here's just some notes I took on the chart. And I would encourage you guys to do this too. Just what I do is I take a picture, put it in a paint program, and then just start drawing on the chart there. That's the easiest way I found to do it. And then from there you can save it in a file and review, maybe some trades you've taken or charts you've been looking at and what you saw. But overall, this company is at about the same price, slightly lower today as it was 2 years ago. A sideways trend with some ups and downs during that time, right? So we had resistance, downtrend, support, then an uptrend. Then we had more supply and resistance here, downtrend. Then we had support and demand, and then we moved back up to this resistance area, and then supply came in again, and now that's where we're at. Now, in my opinion, this chart suggests lower prices below this area after this gap down this week, indicating that supply is again pushing prices down. Now that would just be a short-term, speculation on my part, but that's what the chart is suggesting at this time. I'm not going to go over the volatility index again, but you can type that into Google for yourself as far as how does that index work with volatility. Also, note that individual stocks have volatility ratings called implied volatility, and that's something that options traders use all the time. Again, this is just a picture of that CBOE volatility index, which is commonly referred to as the fear index. It moves very quickly on a daily basis. It generally spikes on news or other market events, especially when markets move down. And this would be the reverse of that index. This is S&P 500 ETF SPY. And when this moves down, or there's a gap down like this in price, generally that volatility index will spike up. And that's kind of what you see on that chart. Okay, so it's kind of just something that's saying that there's volatility, be careful. But again, we can see volatility on a chart in several ways. One, when a stock gaps down like this and leaves a wide range red bar, that's volatility, and that's fear, right? Because people woke up that day and were immediately probably losing money. You can also see volatility, in my opinion, where you've got a wider range candle. Even if it's a candle with a tail, that's still a wide range candle, and that also indicates some volatility versus a narrow range candle. Like these two candles are more narrow range, or this is a narrow range candle. Bitcoin. Now let's get into some market review since the last time or last month that we looked at these general markets and Bitcoin. So Bitcoin has had a nice run up here for the past couple of years, right? Kind of nice consolidation here area here that could have been bought, and if you would have held on that up to this point, you would have had a profit. But let's look at some indications that Bitcoin was potentially going to be sold off. And first indication was it made this new high, indicated by that half circle. Left a little bit of a wide range candle with a topping tail, and it closed lower because it was a red candle. So that was kind of strike one in that sequence, that, watch out below this area. And when it breaks that area, it's, you should really consider getting out at that point so you don't lose money. But the second indication that this was going to go lower, and it did go lower, was this wide range red candle breaking this support area. Okay, again, volatility came into Bitcoin, and since this point in time, over the last 4 months, has been in a downtrend. Okay, but we could kind of see that on the chart. Topping tail candle, range expansion or wide range candle indicating volatility to the downside, breaking support, price moving below these moving averages, all signaled a greater potential for lower prices in Bitcoin. Now the NASDAQ ETF QQQ, we've got, the past 5 months, just doing the calculation between this closing price and this closing price. I did that calculation for you here so you know how to do it, but you're just going to take this closing price here minus this month's closing price or this week's closing price, and you'll get how many points it's down or up. Well, you're going to take that number, divide it by the first number, and you get this decimal number. And you can either slide the decimal over, or you can take this number times 100, and you get a percentage of how much it's lower over these 4 months. And it's just over 3% lower over this 4-month period. To me, it's still just kind of a consolidation in an area of caution. I would not say this is dire at all, but we do have some red volume, indicating sellers are trying to either take profits or get out of this market to some degree. So my question on the NASDAQ is this signs of a top or a stage 3, or is this just a new base and we need some more time for valuations to catch up to current prices. So we need to look at a lower time frame, I think, to get some more information, and maybe even look at some of the valuations within this index. But it has been slightly lower over the past 5 months. So when we look at a different time frame, here's a weekly time frame, right? This is a monthly time frame. When we look at a weekly time frame, we can see, again, it's just some signs of selling. We made a new high after this nice long uptrend since April into the end of the year. Kind of sold off, came back, couldn't make a new high. Could make a new high here in January, late January, and then we've got a little bit of a range expansion candle, red, going into February. So we've got also some support points here. These two support points have been broken. If it breaks this next one or gets near that, I think you could see the NASDAQ go into a little more of a sell-off. Now, if it doesn't break support and buyers come back into this market, that could be very positive for that going forward. Here we've got the 9-month daily chart, and we've got some resistance up here on the chart. We've got a new high way back here. We had a pretty significant sell-off into December last year. We had some buyers come in, push up prices. They tried it again. They tried again, could not break resistance. And up here, it broke resistance, but immediately sold off. So that tells me there's still some overhead supply. We also have a wide range candle here, and we also have a wide range candle here. And interesting is that prices are now closing down towards the kind of towards that 100-day moving average. And we also have what I call a 3-bar sandwich, where you've got a red bar, a green bar, and then a wider range red bar on the end. They're sandwiching these buyers and probably stopping them out of their positions and causing prices to go a little bit lower there on that day. So there's definitely some selling pressure in the NASDAQ. And I know now what happened after this picture was taken slightly before the close of this week. So this would have been Monday or Tuesday of last week. And what happened was, so think about this. This is where it looked like it was going to go lower, right? And now after that, it did go lower. So we get another red candle below the support area. We get this low point, and then we get on Friday, we get the NASDAQ up just over 2% when I took this picture. But now it's created this pivot, and now it's created this lower pivot. So that really puts this uptrend in question. Now, another interesting thing is we've got the transportation average ETF IYT. This looks totally different than that other chart. This looks like higher prices in blue skies above where there is no resistance, there is no supply. So you can see a resistance area here. We can see some new highs here. We can see a gap down, but prices kind of sprang right back up. We can see some green volume, a lot of green volume. And then we broke out through that resistance. So that looks very positive as far as prices going up for that ETF, for that index. Can you guys see a difference between the NASDAQ ETF and the transportation ETF? Okay. So this is just comparable technical analysis. Here is a chart of the Russell 2000 shares, symbol IWM. This is more of smaller cap stocks from different industries, but this is still in a major uptrend with all 3 major moving averages pointing up. Looks like we bounced off of this 25-day moving average. So that looks like that could be a bounce after a slight pullback, and that looks like that should go higher. Okay, that would be my expectation for that chart. Now, be careful though, because the other two big indexes can pull these other smaller indexes down. So that would be my one caution on that. Here we have the Dow Industrials ETF, symbol DIA, referred to usually as the diamonds. Again, still in an uptrend. Price is still kind of following the short-term moving average. We just made a new high on Friday. So that uptrend is still intact. That looks very good for that ETF going forward. Then we get to the main ETF that we use for comparison. That is the S&P 500 ETF, or the SPY. But again, the SPY up here has been sideways for 5 months. This is a monthly chart. Based on closing prices, it's only up 1.4% over 5 months. Now, it's not down like the NASDAQ, but it's basically just consolidating, going sideways. And it looks like valuations are trying to catch up to price. So if that keeps going sideways, that's a good thing. It may pull back a little bit, but it's still an uptrend. I would not want to sell that. To me, that'd be more of a hold. This is a weekly chart of the same ETF SPY. So in this, I'm just showing that we had a strong close Friday, but for the week, we were actually down, slightly down 0.20%. So you can see that here. Here's the weekly number, down 0.20, but on Friday it was up just under 2%, almost 2%. That's a really strong day for an index ETF. Anything over 1% is very strong. So my question on this chart would be, will this weekly base break to the upside or fall apart and go lower? So to me, this looks like a nice, multi-week base, and that could go either way. That's my question on that chart. Here we've got a 4-month daily chart of the same ETF, SPY, daily chart, right? Daily chart. And we can see pretty clearly on here some resistance or supply areas, right? Just drew some lines across, straight across. And we can also draw some support areas right through here. So the daily on the SPY, we actually made this lower low versus this area. But it's confusing because Friday it had such a nice move up. Up just on Friday it was up 1.92%. So in my opinion, we don't really have a definitive direction yet, longer term for the SPY. But near term, I'm kind of expecting a little more volatility. And by near term, I would mean, over the next days and weeks. So let's take a look at another stock using a symbol BSX. When to buy or sell using a chart of supply and demand. How do fundamentals relate to the BSX story? So this is a chart. This is a quarterly chart. So each candle on here is 3 months. So quarterly chart, Boston Scientific Corp, symbol BSX. Again, you can look at this for yourself, but I just took some notes. So this is an example of a stock I would not buy at this time, as price has extended up over 7 months, and yes, it has pulled back or corrected through price and time, but the probability of a high odds trade or investment with a good risk reward is not there, in my opinion, based on this chart. It may have a great business with a great fundamentals, but the time to buy was in early 2003, right in here after this base, or even earlier back in 2015, right here as it broke out from this base. Okay. Now here's the same company on a monthly chart, and this is more clear on the monthly chart as to why I would not buy it right here, because you can see that we had this base, which could have been a stage 3, and that's kind of what it turned into, where we had this new high, range expansion, red candle, sideways, and then another range expansion candle to the downside with increased selling volume. So that looks, and now it's closing at about the 24-month moving average. So that looks like that has some definite selling pressure in that stock. All right, let's take a look at some fundamentals on Boston Scientific. One interesting thing about bar chart is when you get this overview page, you get a quick chart right here. You get some basic information on volume, price, weighted alpha, 5-day change. So over 5 days, this stock is down 18.45%. That's not stock I would want to buy into at this time. So let's go to the live information of this company. We'll just look at a few more fundamentals on BSX at this time. And then we will go to take a look at some other charts. So here I pulled up BSX. This would be more of a live page. Bar chart's opinion is a strong sell based on technical factors. But you can see here quickly just on a chart, on a 1-month chart, you can see this stock is gapping down, going sideways, gapping down. That's not something that you would want to buy into. Here's a quick 3-month chart showing the same price action. A 6-month chart, 1-year chart. You can just see the downtrend. And you can see that stage 3 top, in my opinion. But another interesting thing about this summary page is that over here you'll have some news, but you also have a business summary of what Boston Scientific company does. You'll have some fundamentals on the company, like market cap, shares outstanding, annual sales, annual income, and some other accounting terms like EBIT, a beta number. But here's some of these ratios. Price divided by sales is at 5.73. That's not too bad in my opinion. Price divided by cash flow is 21 times cash flow. That's kind of normal for a company that size. And then price divided by book. And then over here you get price divided by earnings, which is 25.46. So both these numbers, 25 and cash flow 21, are kind of towards the range that, it's going to be hard to get those to go up. Most recent earnings, the next earnings date, and so on. Does not pay a dividend. But one thing that this site, most sites don't show, is market cap divided by earnings, or market cap divided by income. So we could take a look at that with our calculator. Let's just pull that up real quick. And we can see that if we take market cap, which is $113 billion, right? Big company. Let me type this in real quick. And we have to add onto the end of that the extra digits, okay? 113 billion company divided by its earnings or its income, which we'll use that right here. Income was $1.854 billion, okay? So we'll divide this by 1.854 billion dollars. And that's going to give us a ratio of 609 times its income. So to me, that's a very high number when we look at, what this company, that seems really high. I wonder if I did that right. Let's try that again. 13,065, 848. So we have to add 3 zeros K. 1, 2, 3. Divided by Annual income, 1.854 millions. I wonder if that's right. 1,854 thousand billion. I think I did that right. Oh, there, that's better. 60 times. So this company is valued at, right, the valuation based on market cap divided by its earning potential is 60 times its income. So for every dollar invested, I have to wait for 60 years to get my money back. Well, I don't want to get my money back in 60 years. I want to get my money back in like 3 to 5 years, 10 years maybe, right? So to me, this company has a fairly high valuation, and I think that kind of makes sense now why we see the company selling off in such a hard way, because it's essentially kind of overvalued. And I think that's a very helpful exercise for you guys to do. Market cap divided by annual income or earnings for valuation. And now we can see here on the side, another nice part about bar chart is it's got these related ETFs or funds showing a 3-month change. And this company is minus 23% over 3 months. And meanwhile, the overall market and its peers are actually up a little bit, up between 3 and 3.5%. Okay. So that's interesting. Then we look at Boston Scientific related stocks over the 3-month period. And here on the top is Boston Scientific, down 23%. Abbott Labs down 11.3%. And others are actually up over the same period in the same industry. So Stryker is up 1.27, and Medtronic is up 14. ResMed is up 8.8%. So in this case, maybe I would look at, let's just take a look at Medtronic. Let's take a look quickly at a chart of Medtronic as a possible opportunity, right? In the 5-year chart, looks pretty good, right? It looks like it's had this downtrend. It's come, price came in at the sideways base, and now it's kind of above that base. So this, may be an opportunity to maybe consider looking at, maybe studying the difference between Medtronic and something like Boston Scientific. Maybe it's a little bit of homework there. But then we go here, we can see the fundamentals, and we can see that here, price divided by earnings, this number is lower than Boston Scientific, which was about 25. This stock also pays a dividend, whereas Boston Scientific did not. We also have other ratios, right? 13 times cash flow versus I think the other one was 18 or 20 times cash flow. And price divided by sales is just under 4, whereas I think the other one was 5 something. But here we could take annual income or market cap divided by that income. Let's see what kind of number we get with this one and see how they compare. So you just do a little comparative analysis on companies, and I kind of wish this number was readily available on bar chart or other sites, but I'm not sure it always is. Again, you have to add some zeros because this is K, so we have to add 3 zeros. Okay, and we're going to divide that market cap or valuation by annual income, 4.662 billion. 462. This would be 1,000 by $1 billion, and we get 28 times income. So that's a lot less than the other company, which was 60 times income. So I think you guys can see how that can be a helpful number when comparing companies, right? Again, 28 to me is still a little bit high, but with a lower PE, lower price to sales. I think this would be, and the chart in somewhat of an uptrend, right, over last year. Over a 3-month period, there is some selling pressure on the chart with these topping tail candles, but I think that can give you guys an interesting look at how companies are valued. Okay. Now let's get to one more thing, and then we'll wrap up this video. Here I created an ETF list. Okay. This is just a list I go through maybe once a week to a couple times a month, just to get a feel for the market, right? So again, here's Bitcoin. These are all going to be monthly charts, and then I can look at the SPY very quickly, right? I can quickly determine, that's in either a plateau or a new base, but still an uptrend overall. The Qs, again, kind of some selling pressure there. We already talked about that. This is the equally weighted Q index. Then we've got the Russell 2000 ETF IWM, right? Still in an uptrend, new highs last month. Diamonds, new highs this month, so still very strong sector or index. Transports, new highs this month, very strong. Then we can see the VIX. That's currently about 17.76, slightly elevated volatility. And then we can see this ETF MDY, which measures mid-cap stocks. Again, breakout to new highs. Small cap stocks break out to new highs there. Then we get our sector ETFs. Right, so here's energy. Interesting that that's breaking out to a new high this month. Financials, more of a plateau look, possibly stage 3 or possibly a new base for the next move higher. We won't know really until that happens, but still trading above all the moving averages, so no reason to panic there. XLY, which is consumer discretionary spending, new high last month, but then a red bar this month. So far, this month we're down 2.6%. So that's one to watch for. Just keep an eye on it if you have stocks in that area. That is not a warning bar yet, but just a watch. XLV, healthcare sector, looks pretty good. Right, we got this high point here. We've got this kind of pullback in price over time, move back up, just made a new high last month, but with a top and tail candle. Now this month, so far we are up 1 point, just under 2%. So that looks pretty good in general for healthcare stocks. Also, we've got here S&P Technology. XLK, this chart is going to look very similar to the NASDAQ, very closely related to those stocks. Again, still kind of finding its way here, still above all the moving averages. Not a panic yet, but potential for a sell-off is there. So that's just a watch. XLU, the utility sector, had a very nice last couple years. New high in October, but since that time has not made new highs, but still trading above the moving average. I would consider this bar not a warning bar, but just kind of a caution, this candle. If prices continue to move back up, they could ignore that selling. So that's a watch on utilities. XLI, the industrial ETF, similarly related to the Dow Jones Industrials, but just a larger grouping of stocks. Made new highs in January, now new highs also in February. So that's very bullish for industrial stocks. Then we've got the materials sector, symbol XLB. New highs in January, now more new highs in February. Bullish chart there. Communications sector, XLC. More of a cautionary, potential stage 3, or is this building a base for the next move higher? A little bit higher red volume. So far down this month, 3.6%. So that's a little bit of a caution there on the communications sector and those stocks in that sector. Then we've got the XLP, which is a consumer staple sector, or stuff that consumers buy and need. So we had this nice igniting candle in January, now push up in price to new highs and blue skies in February for consumer staples. So where would I look for potential opportunities right now? So what I would do is I just pick one of these ETFs, right? And I would say, okay, let's look at some more data. If you click this tab, more data, you'll get a little more information on that ETF. But then if we go to a full quote, we can see a little more information about this sector ETF. And again, you'll have the opinion from bar chart on that, and we'll have some price earnings information for that ETF. It pays a dividend yield. It has a low management fee of 0.08%. How many assets are under management, and other information. Okay, so we also have a fund summary, right? So this just tells you about the fund. The Consumer Staples Select Sector SPDR Fund seeks to provide investment results that, before expenses, correspond generally to the price and yield performance of the consumer staples sector index, right? Then we can look at related comparable instruments. Here we got that sector up over 3 months over 16%. That's very strong compared to these other ETFs, okay, and how they're doing. Then another interesting bit of information that I like about bar chart is you've got the top 10 holdings of ETFs. And this just shows some common names in that ETF that you would probably know and recognize. So in this fund, which is an ETF fund, right, we can see that Walmart is the top holding in this ETF. Over 11.6% of the ETF is Walmart stock. Then it goes down to Costco, just over 9%, Procter & Gamble, Coca-Cola, Philip Morris, just under 6%, Pepsi, Colgate-Palmolive, Mondelez, Altria Group, and Monster Beverage. So you probably recognize most or all of those companies, right? Well, another thing we can do is we can look at this tab here where it says See More, okay? That'll take us to a new page of the constituents within that ETF. And it shows that in this ETF, it's got 40 different companies in that ETF. And within the top 10 of this ETF, 63% of the fund is in these top 10 stocks, okay? And again, it's going to show a list of the stocks within this ETF based on the percentage holding. Again, Walmart's at the top, followed by Costco. And if we keep going down, we can still see some names we recognize, like General Mills, Dollar General, Hershey's, Dollar Tree, Kraft Heinz, Tyson Foods, and these other very large consumer staples products companies, right? A very established industry. But another thing we could do is we can either save this as a watch list, or we can just go to some charts right from here to look for some opportunities, right, based on the charts. So remember the overall context of the market. The SPY is kind of sideways. The NASDAQ is down a little bit. And yet consumer staples in a few other areas are up here in 2026 and over the last 3 months. So here is a chart of what? Walmart, right? New highs for Walmart. Costco had a pullback, and now it looks like buyers are starting to step up again and buy Costco. So that could be one to investigate. Procter & Gamble. That chart looks a little bit different than Walmart, doesn't it? A little more of a sideways trend. Coca-Cola, had this long consolidation period or a base, and then we had that green candle with a red candle in the middle, and then a green candle, right? What I call a three-bar sandwich, where the sellers in the middle got sandwiched and had to close out their positions. causing even more buying pressure. And now we're into new highs on Coca-Cola Company. So that chart looks great for Coca-Cola. I'll just go over a few more and then we'll end this video. Philip Morris looks pretty good. Pepsi was in a long-term downtrend. It looks like investors and buyers are looking for value, and definitely there's some money flowing into Pepsi there. More of a bottoming chart. Colgate-Palmolive, similar looking chart to Pepsi. Mondelez Company still in a downtrend, so a little bit relative weakness there in Mondelez. Altria Group looks pretty good. Looks very similar to like Coke and Procter & Gamble. Monster Energy, still in a nice uptrend. Extended on the chart, but still in an uptrend. Target, major downtrend. Looks like maybe that downtrend is nearing the end, but still kind of trading there towards or below the moving averages. So that would be a watch. So we'll end it there. Okay? But you guys can look through the stuff yourself. That's a way that I would be looking for opportunities right now, is just kind of focusing on a sector that's starting to perform, and looking for stocks or ETFs within that sector. Okay? So let's end it there. Again, thanks for visiting the Laptop Trader channel on YouTube. Remember to subscribe so that you get the latest video of what is going on in the markets. Please like and share if you found this video helpful to you. Good luck. See you next month. Any questions, you can email me at laptoptraderphil@gmail.com. Goodbye and God bless. See you in March.